Hello and welcome to this week's ITPM Flash. My name's Ed Shek. It's a pleasure to be here with a title, Will Falling Inflation Bait the Bear? So I'm here to discuss the probability that actually falling inflation might be terrible for equity markets. Not initially perhaps, but definitely after the initial hoo-ha. A bit controversial, so see what you think. Now, what are we supposed to think when inflation falls? Well, of course, we're supposed to say hoo-ha. It's a good thing. It's going to allow the central bank to pause. And we're told every day with great historical precedent that when a central bank gets to the end of its tightening cycle, reach terminal rates, risk assets rally. There's a relief rally as rates stop going up. And then, of course, we expect inflation to carry on its merry path down towards target. And that will allow the Fed to cut rates and the bond market will be proved right. So we can see this in the bond market. We've seen it for a year. All good news, right? Well, let's see what the Fed's saying. Now, before you sort of roll your eyes, I know the Fed hasn't knocked it out of the park over the last couple of years. And it's often different what they say and what they do. And I get that. But Jerome Powell's been quite specific about the mistakes they made back in the 70s. And that was the last time of extremely high inflation falling back to a new normal trend. The mistake was that they cut too early. So Fed's funds rate tended to follow the CPI down. And that allowed inflation to re-accelerate from, albeit a lower level, take hold again. And it was the secondary effects of the inflation rush that did the more long-term structural damage. And that's why he uses the word restrictive. We're going to be restrictive. And to me, what that means is that we're going to leave the Fed funds rate way in excess of the CPI on the way down. Well, think about it. We know they've been too late going into the inflation crisis. They don't really want to be too early coming out of it. They would have topped and tailed it like your average retail trader, right? So they're quite incentivized to be restrictive. So let's take it to the charts. So it's just a simple chart and we've got Fed funds rate and we've got the CPI. And as you can see, we've recently crossed over. So finally, the Fed funds rate is just a smidge above the latest CPI print. And then, of course, I've extrapolated what CPI is expected to do and what the market's really saying the Fed's going to do. And these sort of cuts are priced into the bond market. So we've crossed over, inflation continues to track lower, giving the Fed ample room to cut rates. Now, if we look at the second chart, this is what I think will happen. And the implications could be enormous. So again, we can see CPI tracking lower, but you see the Fed funds holding out at terminal rates. Holding out until we get a gap. Now, I've arbitrarily put in a 1.5 point gap. That's very much my assumption, but it just illustrates the point I'm trying to make. That's what restrictive looks like. Now, before we go into this enormous implication I'm talking about, or potential implication, let's think about how inflation is in fact going to track down towards target. Now, if we look at the current rates of change, CPI has gone from 5.4 to 5.1 to 4.9 and expected to be 4.7. So if we think we're just going to have this immaculate disinflation, what that means is the ultimate soft landing. And that means rents are going to start to fall materially. And of course, rents are the biggest portion of the CPI. And it means wages will plateau. And of course, there's no drama in the housing market, jobs market, consumer spending. Everything holds like it's holding now. And inflation just dissipates back towards target. Now, I don't think this is very likely. But even if it is, go back to chart 2, restrictive rates. The Fed will keep the gap. What's more likely, in my opinion, is that inflation is not going to get anywhere near target without a recession. And you only have to look at the market over the last 3 or 4 months to see the economic data is unbelievably resilient. right? Wage creation is still solid. We've just had GDP revisions. Pricing is still being robust. No drama anywhere in the market. And risk assets are doing fine. We're not talking about the pain trade, but we understand why it's in place and it's happening as I speak. So what's the Fed going to do with the market being so comfortable with rates at 5.25%? Well, they'll just keep grinding them up if they have to. And they will do until something breaks. So I think it's far more likely that inflation's going to come down, which it has to, only as and when the Fed causes a recession. When's that going to be? Don't know. Not important. But they're going to have an even bigger incentive to keep that gap and be restrictive. Because after all, they can turn to the market and say, look guys, you all said inflation, or we all thought inflation was going to come down a lot faster. It's been even more resilient, giving us even more incentive not to cut too early and let it back out of the bottle. So in the more likely scenario that inflation is going to fall only when there is a recession, we still end up with chart 2, restrictive rates. Okay? And this is where the big implication comes from. So I'm saying that we're only going to get inflation on its pathway down towards target in a recession. And due to the Fed's restrictive nature, we're going to get real positive yields. And the implication is from asset allocation. Okay? We haven't had real yields for a while. And that gives a real incentive for people to own fixed income for a real return, albeit 1.5% or 2%, versus buying equities that are just entering a recession as inflation's falling, expecting Fed cuts to help. And we all know that when the central bank starts cutting, risk assets are usually going down because you're entering a recession. Now, if top-level asset allocation strategically shifts out of equities into fixed income, you take away one of the big supports of the pain trade. And that's long-only institutions are buyers of the market. Well, they're not if they're getting redemptions. They're simply for sellers. So, recession is the only way we're going to get inflation down. Fed restrictiveness means we have positive real rates. Asset allocation then moves out of equities into fixed income, just as earnings are falling, just as the markets are entering a recession. And that is why, at some point, inflation falling could be a trigger for a terrible market reaction. So be careful what you wish for. Falling inflation might well bait the bear. Thank you very much. Bye-bye.